The markets fall asleep as we get within the gravitational pull of this week's main event. That, of course, still is Friday's Jackson Hole speech from Fed Chair Jerome Powell. But before then, a critical bit of stage setting beckons that should color the way the markets interpret what the Fed chair says, and of course, then what his comments will mean for stocks, for currencies, for bonds, for commodities, you name it. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive, and what we're going to focus on here is just what we've heard from the Fed to shape the guidance, how that's been market moving both over the past month and, of course, most recently. And then what economic data will come here in these next 24 hours to give us a read-through on the context for what this will look like when we get the big guidance update from the Fed on Friday. So the key question, not surprisingly, is the Fed already too late to cut interest rates? Which is to say, have they already created a situation in the economy where things are slowing and need policy support, but they are still waiting to deliver it? So let's do a bit of stage setting first. Number one, the reason that the markets had a bad second half of July and a crescendo of negativity in the first days of August is they were concerned about recession. Let's make that point here abundantly clear, because there's, of course, been a ton of ink spilled about the carry trade this and Japan that and so on and so forth. Let's be very, very clear here. The top in both global and U.S. financial markets occurs in early July. It occurs before the fireworks of August 1st or 2nd. It occurs before the dramatic explosion in volatility on August 5th. None of those things have anything to do with where this actually starts. They are symptoms, not the cause. The symptoms begin to appear July 9th, 10th, and 11th. We can see that here because what we find at the top of the chart here in the red is the S&P, or rather the NASDAQ. In the green is the S&P. And then on the bottom here, just to keep ourselves honest here, there is the MSCI World Stock Index. So that's global equities. And in the green is that same stock index excluding the U.S. So taking all of the sort of AI, Magnificent Seven, swelling tech enthusiasm bit that has been powering U.S. markets out of the equation. And what we find is exactly the same thing. The tops occur in early July. And the reason they occur in early July is because Fed Chair Jerome Powell comes out and signals a head change at the Fed. And lest we get overly stuck on this Japan carry unwind thing that suddenly everybody is an expert on, let's make this very clear. The yen begins to rise when stocks find a top. This is not unusual. This is normal. This is because interest rates in Japan have been near zero for going on 40 years. And so when the markets are in a generally positive mood, they are inclined to borrow for next to nothing in yen and then invest in higher yielding assets. when there is some sort of a negative situation in stock markets and thereby in overall appetite for taking market risk among investors, they unwind everything. They sell off their higher yielding assets and go in the direction of safety. Part of that is covering things that they bought with borrowed yen and paying down their yen loans, which just means buying back shorted yen. And not surprisingly, leads the yen higher. This is not unusual. This happens every single time there is a significant risk-off sweep in markets, or almost every time, because of course nothing is absolute in markets as in life. So that there was a yen rally here when markets topped is completely par for the course. We'll notice that the BOJ doesn't issue their surprise rate hike that everybody was so quick to finger as the reason for all of this. That doesn't happen until almost 3 weeks later. And of course, we can see here the positioning in yen, the short exposure starts to come off, the yen starts rallying. All of that comes later. So why was it that what the Fed said registered so negatively for markets? Well, let's consider what it was that the Fed said. And of course, we got it in spades in the July policy announcement, but what the Fed said or Fed Chair Powell said in the testimony ahead of the July 31st meeting, again, back July 9th and 10th, really follows this script right here. This is directly from July's policy statement, and the preview of it came in that testimony, where the statement here and what Powell said earlier tells the story of inflation coming closer into target, of job gains cooling, and of the risk to growth now elevated on par with risks to inflation. The last sentence of this paragraph here, the second one in the statement, really tells the whole story. And I'll quote, "The economic outlook is uncertain, and the committee is attentive to the risks to both sides of its dual mandate." Whereas the sentence just the previous month in June said, the economic outlook, yes, is uncertain, but the committee is highly attentive to inflation risks. This is obviously a change of course. We get confirmation reinforcing as much today as minutes from this very meeting are released. And what do we see? Number one, the Fed's outlook for economic growth in the second half has been marked down largely in response to weaker than expected labor market conditions. Notice, this isn't just weaker labor market conditions, something the Fed was telling us would happen when it started to hike rates. We're going on 3 years now. From the middle of 2021, the Fed has been saying, we're going to have to hike rates. This inflation is not as transitory as we thought. It's not going to take care of itself. We're going to have to do stuff about it. And the stuff we're going to have to do will probably cool the labor market, will probably take some of the wind out of the economy's sails. And everything they were saying in 2023 and going into this year was, oh, look at how surprisingly resilient the labor market has been. Look at how surprisingly resilient economic growth has been, given how rapidly we've raised rates. But don't think we're out of the woods, because we still think there's going to be a slowdown and the labor market is going to have to cool in order for us to get to our inflation goals. So when the Fed says the labor market has been weaker than expected, that's weaker than their baseline of a weaker labor market. In other words, not only is the market weakening, which is what the Fed wants to see, or at least anticipates seeing. It's weakening more than they thought. A majority of participants, and I've highlighted the way that the Fed sort of tacitly nods at consensus here. Some of these things are ascribed to a majority, some to many participants, some to several, and of course at the end, a vast majority, which is to really say unanimity is essentially there. A majority of Fed officials think risks to employment have increased. Many thought the risks to inflation had decreased. Many participants said that easing policy that comes too late or that is too modest could unduly weaken economic activity, while only several said that reducing policy too soon could risk a reversal of progress on inflation, which is to say, a preponderance, a majority of Fed officials now see the risk of over-tightening as more significant than the risk of under-tightening. Many versus several. Here's the punchline. The vast majority of participants said that it would likely be appropriate to ease policy at the next meeting, that is to say, September. In other words, what we've been talking about for a while now, the September cut, that's almost a given reading this. But the atmospherics are telling us, wait a second, we could be looking at a situation here where the Fed has underappreciated, let's say, how long this sort of wait and see approach on rates was likely to be appropriate. That the Fed has already waited for much too long to begin cutting rates. Because indeed, we find that the Fed is, according to this, again, finding that the labor market is undershooting relative to their own expectations. And so the interpretation that the market then has from the Fed, when we look at the way that it's responded here, to say, oh, well, the Fed now feels that cuts are more immediate, is to say, they now think it's go time, and it appears like they may have missed when they should have gone already. As a matter of fact, it turns out that what we have here is something that the markets have already been screaming at the Fed since mid of April. And that's exactly what we see here. Note what happens when the Fed already then starts saying, oh, inflation isn't falling fast enough. We need to probably hold off on cutting. Maybe we don't need to go fast. The labor market is relatively strong. There's no rush here. We don't need to go and basically risk the progress that we've made on inflation and go too soon. This strong labor market is affording us the opportunity to wait and really make sure that inflation is good and dead, and then we'll start to move ahead. And of course, in June, they actually take the formal step of revising their outlook to say we are going to not go through with the 3 cuts that we thought were on the menu when we updated in December and in March. Now it's going to be down to 1 cut. Look at what the markets do in response. They say, well, if you're only going to do 1 cut, that's the gray bars here, Since you're already behind the ball, you're going to have to do many more cuts in 2025 to catch up. And even before this sell-off in July, this is, of course, the S&P 500 right here. Before that occurs, we're already almost double for the stock of rate cuts on the menu. We go from 76 here at the end of June to 133. Nearly twice this amount. So the market is already, for months, telling the Fed, you're behind, you need to cut. So when the Fed then actually comes out and says, okay, it's go time, now we feel that we're convinced, the market says, well, by the time you're arriving at this idea, you should have been cutting already. In fact, some Fed officials thought as much. Note here that several participants said that given the way things were developing, there was a plausible case for a 25 basis point cut in July. That is last month. And that they could have supported such a move. So the markets are already saying this. Fed officials are starting to come around to that idea, at least some of them. And now it becomes that a vast majority sees go time in September. And from the market's perspective, since this is too late, this is a growth risk and suggests that now that the Fed, even in their reluctance, have been pushed to want to cut, and the urgency has entered into their conversation, that something is occurring in the business cycle that is intolerable enough. That these are not maintenance cuts, that these are stimulus. Because the economy is producing a labor market that, in the Fed's own words, is weaker than expected. Why does this amount to such an issue? Well, we consider that global economic growth consists of fundamentally three major economies, the US, the Eurozone, and China, generating most demand, that the other 50% of global growth are mainly vendors that depend for demand from the three major economies, and that China itself depends on demand from the US and the Eurozone because it sits in the middle of the global supply chain. Most of the rest of the world in the gray area sits in the earlier bit of the supply chain. Then we arrive at the idea that, well, if the US slows, if we are in fact in some sort of a situation here where the Fed has already waited for too long, then there better be some sort of an offset in the Eurozone or in China, or else we're looking at a global downturn without a safety net. Well, as it turns out, the news there isn't great. Here's the Eurozone. These are the latest numbers on PMI. And what we find here is that composite Eurozone growth, that is services and manufacturing together, back to standstill. This 50 line is neither growth nor expansion, or neither growth nor contraction, rather, in the logic of PMIs. Under 50 is contraction, above 50 is growth. So we can see services are still growing, manufacturing is contracting, but the slowdown in services is giving us a downswing in the overall economy after this little upswell at the start of the year, recovering from this recessionary situation here. We're already back to essentially no growth, idling. It's not much better news in China. Same numbers out of China, and we can see here The service sector is at a standstill. Manufacturing is shrinking. So if the Fed is saying, hold on, even we are developing a sense of urgency because the economy turns out weaker than we thought, and the markets have been saying this for a while, because they've, of course, been watching U.S. economic data increasingly disappoint relative to forecasts since, shock of shocks, mid-April, exactly the place where this dovish readjustment starts to occur. Well, then, if this is the makeup of global growth, then there is no safety net. The Eurozone is stuck. China is stuck. And if the Fed is saying that the resilience in the U.S. is giving way such that they are getting a sense of urgency on rate cuts, where is global growth supposed to come from? Ostensibly, nowhere. And this is why we are going to be very closely focused on August's update of global PMI numbers, which will give us the backstory against which the Fed now has to cut rates. Now, we can see here for Japan, for the Eurozone, for the UK, and for the US, it is somewhat of a mixed bag. The Eurozone seen at standstill still, the UK growing, but not any faster than before, according to expectations, and the US a little bit firmer as services perks up. But as we saw with the US here, and this deterioration in data outcomes relative to forecasts, we can see we are now well below zero, which is to say US economic data now tends to come out weaker than median forecasts. We have an even more ominous global story, where economic data outcomes have been absolutely unraveling compared to forecasts and have been increasingly disappointing those forecasts since about the middle of June. In fact, global growth has already been slowing for 2 consecutive months. Here's the global set of PMIs, and we can see here, both in June and in July, global economic activity slowed. And if this is the story of how these numbers are going to behave, well, then we're in a situation where we're going to get another round of disappointments and perhaps a third month of global deceleration, which would only make a modest Fed rate cut, at this point a given for September, or almost so, at least listening to the Fed minutes. It would make it seem inadequate. It would make it seem like the Fed is, again, hopelessly behind the ball, much as we were seeing the markets anticipate here. And of course, as the markets got the signal that this might be the case from a Fed more worried about growth in early July, what was the result? Weaker stocks, even as the outlook got more dovish. As we've gotten this rebound in stocks, investors have not become much more optimistic. The tally of rate cuts hasn't really changed very much from these extremes. So if the Fed comes out and says, okay, yes, here's one cut, but there's no emergency, there's no hurry, there's no panic, takeaway may well be, yeah, well, you're just behind again. And this is not enough. Taking stocks right back down again because it is global recession that people are worried about, and it is global recession that is motivating things to move around, or at least the fear of one. And that is macro money for today. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what may follow thereafter. I'm on with Victor Jones in just 30 minutes time, as I am every Wednesday for The Price of Truth. Back on with Chris for Futures Power Hour on Friday. Back with Victor and Tom for First Call on Sundays. Writing for the News and Insights portion of tastylive.com and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money's back tomorrow. See you then.